Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Funding Value. If you like making money, this channel's for you. We talk a lot about undervalued assets, particularly in commodities. And subscribe, if you like that types of stuff. Give me a thumbs up if you like this content. Leave comments below if you guys have questions or anything that I can answer. Maybe I'll answer it through a video. But today we're going to talk about commodities. I'm going to touch into why there's such good plays, the deficits, ore grades, all that stuff. So this is the clip for an investor to better understand the conditions and commodities itself. So let's jump in. I call this commodities. And I'm going to talk about commodity extraction. So we look for market balances that have deficits. Deficits are that the demand is greater than the supply. It eats into inventory and it increases prices. And that's where I like to be, is market balances that have deficits. Also keep in the back of your mind that you got to know that we have declining ore grades and energy return on energy invested is declining. And I'm going to go over a couple slides about what that is. It leads to higher costs for production, both from energy costs and extraction costs for declining ore grades. In order to increase production worldwide, there's a couple of things that have to happen. It's not just straightforward increased production. So in order to increase production, you have to increase new production of materials. That is growth of production, which also offsets existing production declines. So the more you produce, the greater the declines from existing production occurs, which means you have to find even more growth. So if you want a growth at 5 or 10%, you're going to have to grow it maybe 15 or 16% to offset the declines and also grow your existing base. But first, I think we need to understand oil or energy. So this is energy return on energy invested. We call this EROEI. And I just want to show you on the left-hand side, this is time on this axis. This is the percent available for consumption on this axis. So in the beginning, on the legacy oil and gas fields, this is basically a 98% return for available consumption. So you consume a couple of barrels of oil and it nets you 98% of it back, 97%, wherever it is, somewhere in that range. But over time, we're going after harder and harder to get, whether it be harder to get oil like shale oils, tar sands. We're going after things it takes a lot more energy to get the energy. So what happens is you end up expending a lot more energy used for the production of energy itself. And you get a less and less percentage available for consumption to society. So what happens is it doesn't just increase the cost of energy. It also doesn't allow society to function as well as it did before because it's using more energy and more people are deployed to getting and obtaining energy for society than the society having the benefits of that energy to use. But this is what it looks like. You can see we've got declining energy return on energy invested over time. And eventually, when you hit tar sands, which we're doing right now, and biofuels, you're almost to the point where everyone's deploying energy just to get energy and have the minimal amount of energy available for consumption just to survive, not really to do things at whatever anybody has a whim to do something. It's not available to do leisure activities, etc. It's just getting energy to maintain life and function of society. Eventually, we'll get there. And this is the annual world discovery and production of conventional oil. This is the discovery, and then eventually you're going to get a peak in the production from that discovery. So it's just an offset by however many years, maybe it's 50 years or so. But if it peaked in 1960-ish and it's a 50, 60-year peak, it could be peaking anytime now in the 2020 era where it could start declining. And this is for oil production, conventional oil production. The growing gap, this is regular conventional oil discovery and production. The production is this curve here. And then these are the discoveries, and you can tell that the discoveries are declining, which means that eventually you're going to have declining production at some point, because we are right now consuming more oil than what we're finding, and that's what this gap is. And eventually this curve is going to equal this curve. Here is the production in barrels. I've got the bell curve here. And all this is I put all these little bell curves within it. And these are the big bell curves that we were finding. These are the big oil fields that we have out there. And this is, we'll call this one Guar. This is a gigantic oil field. But these are all separate little bell curves added together to create this large bell curve. Now we're finding smaller and smaller fields that we have to keep adding on and drilling and drilling and drilling to keep this guy from really blowing out. And eventually we're going to have this large decline because we're not going to have the oil in the ground to replace the oil that we've already used. So that's kind of to sum up the oil area, is that we have production that easily goes up on the front side. It's very easy to have new findings, to have discoveries, to have a lot of oil production very easily in the beginning. And when you hit the peak, the back half is a lot harder to get. That's what I'm getting at. And eventually we'll hit a peak, and this peak has a bunch of different ramifications to the world and humankind. So commodity cycles, I'm going to talk a little bit more about commodities, the cycles and whatnot. So commodity cycles, they can happen because of many things. Inflation, deflation from real estate. It's from that real estate cycle. We've got demand supply curves of certain materials in terms of deficits and market balances. We have extraction costs worldwide, which can affect the demand supply curves. And then we've got discoveries and inventory of materials that can also dictate the cost of materials. So I'm going to go into kind of just, I got this chart from an article. It's about the commodity super cycles and peaks and bottoms. But right now, we are projected to be at a current, we'll call it a depression for commodities and in a low inflation area. So that's right here. And some people are projecting that this is going to go all the way up and come into a major super cycle and be at the top of a major inflation peak around 2045. That's quite a bit out there. That's 25 years, 24 years from where we are today. And that's just kind of projections that some people have based off of the cycles they've seen in the past. It doesn't necessarily mean that that is for surely going to happen in this way, but it's something to look at in some more data. Now, here's the global silver market annual net balances. I want to show you something here. This is from SRS Rocco report. Lots of deficits. Now, the only way that you can run this type of deficits is if you have inventory. So what does the inventory look like if we've got deficits that look like this in the global silver market? And, oh, hey, look, we're eating through inventory pretty dang quick over time. And I don't know if this is accurate down here. I'm sure they're probably fudging numbers and the market's pretty tight. But let's see what the supply side looks like. Oh, that's not that great. So supply is going up, and it looks like we're peaking out here. Now, is the peak because we have low silver prices? Maybe. I don't know. But it's something to watch. It's something to look at. And this is kind of what we have for global silver supply. Is it in decline? And can we reverse this decline to the upside? We'll have to see and monitor and see what the data tells us. Now, here's the average grade. When I talk about ore grades, this is the average grade of the 12 largest silver mines, and they've fallen. So silver grades have declined 36% in 10 years. From 07 to 2016, we're seeing ore grades decline, and this is going to take more and more energy to get the same amount of production. And it's also harder to extract lower and lower ore grades if you want to go and produce more and more silver supply. And if you want to produce a lot more silver supply, you're going to have to move ever greater amounts of earth to get the same production output. So you're going to have to move even more earth if you want to grow production substantially. So it's very energy intensive. This is a supply-demand balance in 1,000 ounces of palladium. And I just want to show you something here. This is the surplus all the way up to about 2009. And I want to show you that markets are a little bit forward looking. We've got basically a balanced market in 2010, 2011, and then we went into a deficit, a pretty large deficit on the right-hand side here, starting in 2012. So how did this manifest itself in prices? So let's look at the price of palladium to see how this, surplus and deficit manifested itself. Did the price start increasing in 2010, 2009, 2008? What did it look like? So here's prices, and here's the market crash in 08 and 09. It went down, but it looks like it's a steady increase if you were to take out this crash going up. So one can say that if you have market balances that look like this, that go into a deficit like this, that prices will eventually manifest themselves in higher prices. And this is exactly what we want to look for when we invest in commodities. We want to look for this market balance to go into deficit like this, because this means that higher prices in a favorable market for producers are going to manifest themselves in the future. So let's look for some supply-demand market imbalances. So here's one. This is 2020 right here. They're projecting a neutral market balance. And we're coming up on this commodity bull market that we can see commodities in relationship to stocks. So we've got all the right conditions. This is uranium, and uranium's going into a massive deficit starting in 2020 going forward. And it's a growing deficit. So what I would expect to happen over time is that we're going to run into deficits, 2021, 2022, 2023. There might be a period where inventory gets eaten up and idle supply will come back online. And then eventually, maybe that's 2023, 2024, wherever it is. It doesn't matter when. Eventually, the supply will run out of capacity and the demand will exceed the entire supply and inventory. And at that point, prices are going to rocket and we're going to have to bring in new supply. So that means some of these exploration to developer companies are going to have to come into the market and really start supplying the market with new material. And I think that's going to happen pretty soon. And remember, markets are forward looking. So uranium is probably going to have an increase in price over time. So we've got the deficit, the market balance deficit over here. We've got supply deficits is what's projected. Let's look at price to see if it's manifesting itself in price. So when we look at price, we were in a large bear market from 2007 going forward. We've been declining. It looked like it broke out somewhere, 2018 or something like that. Broke out, and now we're heading higher. And you can see a series of higher lows stepping up, which is bullish. It's not just flying higher, but we're moving very slowly to the upside, signaling that people are anticipating a market balance deficit in the future and that prices need to be higher in order to bring on new supply. Here is copper long-term supply and demand. We are in 2020 and we're already starting to see a little bit of a deficit. So prices should be rising to bring on new supply of copper. And this is what it looks like going forward. This is the 3.5% demand growth trajectory. This is the total supply estimate going forward. And you can see a very large and growing deficit into the future. As an investor, we want to look for this stuff. I mean, this is gold to us, or maybe you could say this is copper to us, because maybe copper goes way up in price and is a better performing asset than even gold. But this is very good information to know as an investor, because you want to see this growing deficit to look forward and say, hey, look, there's some growing deficits out there. Let's position today for those deficits in companies that can provide minerals or copper in the future. This is what the copper price looks like currently. We have a broken downtrend and we're heading up higher pretty ferociously, Bolita style here. So copper is looking excellent for investments. And one thing I want to point out about copper is this is the percentage of recoverable copper in ore. So this is declining ore grades over time. And what this means is it's just getting harder and harder to extract. We're getting less and less profitable mines, and that the price has to increase in order for us to extract copper out of lower ore grades. That's basically what it means. And the conclusion here is oil has a tough time increasing production. You've got production declines and you've got growth on top of it, which means we have to find a lot more new oil if we're going to continue to use oil in ever increasing amounts. Discoveries peaked a long time ago. Production will eventually follow that discoveries peak and go down. I touched on a few commodities here of what drives commodity prices. Inventory and market balance drives it. Declining ore grades and increasing energy consumption drives higher prices, and harder to get at discoveries, which means it's harder to get out of the ground. Eventually, we're going to run into a commodity shortage worldwide. I've got one last picture here. It says, how much is in it for me if you're born in 2010? Here are some of the projections of when we're going to have some problems in certain materials. You've got indium, 2030s, lead, maybe even before 2030, antimony, anytime now, 2022, 2023 for metals used in renewable energy sources. So antimony would be one to look at. Zinc, a little bit past 2030, silver, a little bit past 2030, gold, anytime around 2030, and then copper's a little bit past that. But either way, what we're looking for is we're looking for value to society. As an investor, you're looking at all these market balances, you're looking for market deficits in the future, and we're also looking for value to society because you can hit a deficit, but if it's not very valuable to society, people will just use an alternative or not use it at all. If you have extreme value to society and you have extreme deficits, that's where big money is made. So I think copper is a spot because if you have extreme deficits and extreme value to society, I think you can make a lot of money there. Copper's good, silver's good, platinum's good. Oil, I think, is still a really good bargain because it provides, oil is the number one commodity in the world. It's used in everything. Silver is number two. So I think if you can cover these very large deficit markets with high value to society, I think it's just a matter of time before you make massive amounts of money. And if you spread out in all of them, it means that you can capture the gains in all of those sectors that are extremely valuable to society that also have problems of getting those materials to society. So you can not only, one, benefit from it, but you can also be taking a part in, some part of the solution to invest in these companies that need the money to start producing these items. So it will help society as well. So you have a win-win scenario here. So there's also a lot more materials like tin, nickel. There's a whole bunch that if we can get our money, spread it out amongst those, I think we will be exceptionally positioned for profiting for the future when these deficits materialize. And some of them, they're already starting to materialize. Others are out a little bit ways. And if you look at the ratios and the extreme valuations in some of these sectors like uranium, I mean, the opportunities here are so large that you have to know the valuations. Otherwise, I don't think you can hold on through it. So you got to know the value, hold on, and the returns are going to be so big that it could be life-changing. I mean, extremely life-changing. So that's what I'm here to help you to do. If you need help, subscribe to the channel. I go over a lot of updates like this. It gives you confidence to hold through this bull market that's coming up. I give examples of what I'm doing. I can't give financial advice, but I can give you financial education. I can tell you what I'm doing. And you guys can mimic what I do. It's whatever, it's up to you. And in order to do that, subscribe to the channel, watch my videos, give me thumbs up, help me out. Leave comments if you guys have any comments about this presentation. If you have any comments in general about investing, put it in the comment section so I can see it and potentially do videos on it to help you guys out. Thank you for listening. This is Finding Value.